There are numerous things we can learn from Buffett and Munger, but this video will condense their knowledge into 4 enduring truths. Keep watching this video to find out Charlie Munger versus Warren Buffett, who has the better investments. Invert, always invert, Charlie Munger. Munger argued in favor of employing inversion to solve complex investing problems. Munger adapted this notion from German mathematician Carl Gustav Jacobi, who lived in the 1800s. He thought that by inverting the problem, many challenging mathematical issues might be resolved. Munger employs a variety of mental models to aid in decision-making, but possibly one of the most effective is the concept of inversion. How to choose the finest investment manager can be a case where this concept is put into practice. So one may think about and steer clear of what doesn't work rather than concentrating on what does. According to empirical data, making diligent judgments based on 3-year management performance in the conventional way results in underperformance. It's interesting to note that many institutional and private investors still base their decision to hire or fire a manager on the manager's 3-year performance. The facts of management selection cause a counterintuitive consequence, even though not all insights from applying inversion do. As part of a thorough management selection process, investors should either disregard a manager's short-term relative performance or even reward managers that have recently underperformed. Last but not least, Munger used inversion when responding to a query about how to discover your calling at the annual event. Figure out what you're poor at and avoid all of it was Munger's advice. Here are some additional highlights from the most recent annual conference. We never want to count on the kindness of strangers in order to meet tomorrow's obligations. When forced to choose, I won't trade even a night's sleep for the chance of extra profits, Warren Buffett. In addition to their performance as investors, Buffett and Munger stand out for their capacity to generate outstanding returns over such an extended period of time. There are many shooting stars in the finance world who made huge returns, but ultimately failed, occasionally spectacularly. The Berkshire approach continues to be distinguished by risk management. Buffett is renowned for promising to preserve at least $30 billion in cash on Berkshire's balance sheet so he won't ever have to worry about repaying debts. For instance, Berkshire ended the first quarter with over $94 billion in cash, the great bulk of which was held in U.S. Treasuries. Others may legitimately start to worry about the safety and liquidity of even short-term bond holdings during periods of acute market turbulence such as the global financial crisis. This year at the annual meeting, Buffett again mentioned owning Treasury securities. Additional information on Berkshire's profitability and balance sheet may be found here. Berkshire may be relied upon by counterparties to carry out any agreed-upon deal because Buffett has chosen not to take on additional risk with the cash position in order to increase yield. As a result, Berkshire has the dry powder to make purchases. Due to this stance, Berkshire was able to make some investments during times of intense market stress, which improved its long-term track record and reduced its danger of financial collapse. Time is the friend of a wonderful business, the enemy of the mediocre, Warren Buffett. With the help of Munger, Buffett changed his focus from focusing on low-quality, cheaper companies at the beginning of his investing career to higher-quality ones. Buffett now maintains that buying a superb firm at a fair price is considerably preferable to buying a fair company at a wonderful price. As Munger points out, in our way of thinking, all intelligent investment is value investment. Valuation is still important. Some of Buffett's largest and most successful investments, like Coca-Cola and Apple, have clearly fit this mold. These statements are not mere platitudes, but a cutting-edge investigation into Berkshire's investing performance revealed that Buffett's emphasis on cheap, safe, quality equities was a key factor in his outperformance. Buffett's choice to organize Berkshire Hathaway as an insurance firm helped to increase returns as well. The terms float and underwriting profit are the two most crucial ideas in insurance investing. The insurance premium must be greater than all insurance claims and expenses in order to generate an underwriting profit. Simply put, because insurance premiums are paid before any claims are filed by the insured, the float is produced for insurance firms. Insurance companies like Berkshire have the option to invest the float before paying out claims, often for years. Contrary to many insurance firms, Berkshire has a history of making an underwriting profit, which means that their float costs them nothing and generates income in addition to allowing them to benefit from the float's investment. If you own your stocks as an investment, just like you'd own an apartment, house, or a farm, look at them as a business. Warren Buffett. Buffett's mentor, Benjamin Graham, taught him many valuable lessons about value investing, but one of the most important lessons was to study stocks as businesses rather than to respond to short-term fluctuations in a stock's quoted price. According to Buffett, the foundation of his investment strategy is found in chapters 8 and 20 of Benjamin Graham's book, The Intelligent Investor. Buffett mentioned the book again at the annual meeting and noted that it changed my life. According to Graham, stock ownership should be viewed by investors as owning a stock in numerous companies, much like being a silent partner in a closed-door corporation. Stocks should be evaluated accordingly, not as something with a volatile price on the stock market, but as a portion of the company's intrinsic value. Instead of letting the stock market's erratic assessment of a firm direct their actions, investors are able to overlook the volatility of the market by valuing equities as a business and buying shares with a margin of safety. The margin of safety for Graham means paying less than the indicated or appraised worth, which should enable an investment to generate a respectable return even if analysis errors are present. And with that, we've come to the end of our video. All in all, the recent market turmoil made it an optimal time to revisit investment-first principles. Given the growing downside risk to the economy and the current inflationary environment, investors should follow the duo's lead and focus on quality companies with pricing power when searching for opportunities during the sell-off.